decided to make a quick and short panel discussion on the MiCA or MiCA regulation, which has been presented last week by the European Commission. We found that this regulation can be quite interesting because it puts all kinds of crypto assets on a very, very solid fundament. On the other hand side, basically let's call it the normative crypto spirit as we know it from the Liechtenstein Token Act is missing a little bit. That's what we want to discuss today. In a second, I'm presenting the speakers today, but before this, I would quickly like to show you what what we are talking about today, and I truly hope you are now able to see this little slide. So what we are doing here is basically explaining the MiCA very briefly. So what you see here is in dark gray the MiCA regulation. It's a proposed regulation from the European Commission, and you see here on the left-hand side that Bitcoin and Ethereum is basically crypto assets as defined by the MiCA. And then the MiCA regulation defines quite a number of silos for token classes which are sitting in between this gray area. So this is, for example, the so-called EMT token, e-money token. You see this on the upper half. For example, the USD coin and also euro equivalents once existing would fall in this EMT category. And in case the Libra tokenized euro would be existing, then this most probably would fall in the SEMT category, in the significant e-money token category. But there is also traditional e-money not covered by the MiCA. This is on the upper right area, as you can see. And in the middle, you see asset reference tokens. You could also call them ART token. This is most probably the DAI token from MakerDAO. And in case they are getting extremely significant, then this could be Tether or the Libra coin as a basket. That's in the middle. And in the lower half, MiCA also shows that there is the so-called class of utility tokens. I think this is very well known. It's another category in the MiCA regime. And for example, the basic attention token, but also the OKX platform token would fall in this category. And interestingly, on the right-hand side, you see security tokens in the form of digital securities, which would be shares on a blockchain, bonds on a blockchain, probably funds on a blockchain. And these are not covered by the MiCA regime. That's interesting because this way you see an entire new category of crypto assets, which is very diverse, existing and emerging on the left-hand side in dark gray, but it's basically a different segment than the securities which are not covered by MiCA. That's interesting, and I just wanted to create this little basic fundament because if we now start talking about EMT token and ART tokens and this and that token, such that everybody has a little bit in mind what we are talking about. With this, I would like to stop this quick introduction and hand over to the speakers, who I would like to ask to quickly present themselves, their standpoint, and also maybe the context on why they think they should be able to answer a couple of questions on the MiCA, given their professional perspective. Who wants to start? Maybe Robert, would you like to start?
Happy to do that, Philipp. Thanks for having me, by the way. Very much appreciated. And maybe up front, congratulate to the great work you did over the years. I mean, I think the whole industry is profiting from that. So thanks on the behalf of us. I'm the Secretary General of an entity called Blockchain for Europe. We're a trade association based in Brussels, representing blockchain industry players in regards to regulatory issues at the EU level, but also in the member states. We deal a lot with issues like MiCA, but also other relevant regulatory topics. And yeah, that's in a nutshell what we do and who we are. So to not take much time of that.
Excellent. The Blockchain for Europe Association has begun, I think, 1 or 2 years ago, and it's steadily growing. It's basically primarily active in Brussels, and that's also why you and your colleagues are having quite some insights on how the MiCA regulation emerged and how it's seen among the people engaged in the Brussels ecosystem around the European Commission. Excellent. Okay, then Simon, you want to present yourself quickly also?
Sure. Many thanks also for having me, Philipp. Simon Seiter, Head of Digital Assets at Deutsche Börse. We have been quite active in the space. Before I worked at Commerzbank in the DLT lab and did several transactions both on the security and the e-money side. So coming to the MiCA regulation, I'm actually out of the game to some extent. No, just kidding. I think we have to really differentiate what is covered by MiCA, how we deal with it, coming from the experience that we made with other regulations, especially MiFID and MiFIR. And yeah, I'm very much looking forward in this regard to the discussion on the still quite early draft, of course. So let's see.
Excellent. So that's, I think this is absolutely fine. You are head of digital assets. So this is basically head of MiCA, so to say, in case you would also include digital assets, covering all of them. Maybe not now yet at the Deutsche Börse, but maybe in the future. Then we have Lee Schneider here. Maybe Lee, you also want to take the chance to quickly present yourself.
Thank you very much, Philip. Great to be here. Great to be on such a panel with such esteemed panelists. I'm Lee Schneider. I am a financial services and technology lawyer for more than 25 years here in New York. I am right now the general counsel and head of policy at Block One, which is a major blockchain software company. And I've been doing all kinds of work in and around financial services, fintech, and blockchain throughout my career. We are also a member of Blockchain for Europe and do a lot of work with Robert on the European engagement.
So you're also having the US perspective, and you are also, like, let's call it a veteran of crypto assets to some degree. So you can also provide some insights how this regulation fits in the ecosystem as it has evolved in the last years, I guess so. Okay, and finally we have Alireza here, a lawyer from Germany who is also active in the ecosystem of Brussels with the Think Block Tank. Maybe Alireza, I think it's also better if you present yourself quickly than I'm doing it.
Yes, thank you, Philip, and thank you for the invitation to take part in this panel today. And I'm very happy to join this panel on such an interesting topic today. So yeah, as you just said, I'm a Frankfurt-based lawyer. I'm qualified and looking into regulatory aspects. So I'm advising usually regulated institutions like banks, asset managers, but also fintechs and other companies which are into crypto. And I'm doing that since 2014 already. So I started to look into this topic from a regulatory perspective very early. As you said, I'm also a member, founding member and board member of Think Block Tank, a Luxembourg-based think tank, which is a member of INATBA. This is the blockchain association of the EU Commission, where we are quite active in right now, the draft of MiCA. And I'm happy to tell you a little bit about how I see it from a German perspective.
Excellent. That's interesting because there might be some collisions with the German law. Potentially, you have, I think, inspected this with Nina Siedler in a lengthy document, which I read at least partly and I understood partly, but I think you will provide this expertise in more detail. Okay, let's start with the topic now, asking everybody of you, what's your opinion about the MiCA regulation? What's your opinion in general? What do you find very interesting? What you find maybe a little bit disappointing? And most important, comparing it to the quick presentation which I did in the beginning, what would you like to add points maybe which I have missed on this very single slide? Who wants to basically start with this?
Philip, maybe I'll just kick off very quickly. I thought your slide was very interesting, and if one of the questions that I've had with the MiCA and your slide, I think illustrates it very well, is MiCA has this definition of crypto assets, and then it has the sub-definitions of asset reference tokens, e-money tokens, and utility tokens. Does everybody on the panel think that the only types of tokens that are crypto assets covered by MiCA are those three types of tokens? Or is MiCA designed to cover all crypto assets? In other words, all items that fall within the definition of crypto asset, whether or not they are, well, obviously, leaving aside those that are covered by MiFID, right? But everything else, is utility token just a catch-all, or are there other types of crypto assets here?
I think that's a very good question because we first need to decide what we are talking about. The document from the European Commission has had 170 pages. It was very tough to read. It's one-line document, so it's endless text, and it's not enough because Robert will probably explain it later. There will be more delegates acts, so more papers, more paragraphs in the upcoming 24 months, right? So I think Lee posed a very interesting question saying that we have e-money tokens, we have asset reference tokens, then we have utility tokens, and we have the catch-all category of crypto assets where I would find Bitcoin falling inside too. So we have 3 silos. Inside these silos, we have significant silos for remarkably big tokens. And then we have the catch-all categories of crypto assets where Bitcoin, for example, would fall into. That's how I understood it. But please let me know if you also understood it this way or not. Security tokens are excluded. And I personally find that basically these silos, they are covering, let's say, 90% of the crypto market at this point of time, maybe even 95% organized in these silos, right? What is not covered, in my personal opinion, is basically the decentralized finance ecosystem, like tokens you are listing at Uniswap, loans, and so on. So basically tokens which are resembling financial instruments, but are purely decentralized. So issuerless tokens. That's what I wanted to say, especially in the DeFi ecosystem. I feel that these issuerless tokens are missing, but to some degree they are included because Bitcoin fits into catch-all category, right?
I agree, Philipp. I agree. I think there's a nice distinction if you look at the regulation, not only from a singular perspective, but from the digital financial package the European Commission has just provided, because it's not only the MiCA regime, right? It's as well, for example, the pilot regime about distributed market infrastructure. And I think what we see here clearly that the MiFID definition is the divider between like the pilot regime and the MiCA regulation. And so for me, we have a German term, I don't know the English expression, to be honest, it's Auffangtatbestand. So it's like this bucket catcher. And I feel like this is the distinction in which bucket the regulation is going. But I feel as well that there's a difficulty in regulating cryptocurrencies actually according to the MiCA regime, because the MiCA regime imposes liabilities and duties to issuers of tokens, which is clearly not the case for the cryptocurrencies that are not, or those cryptocurrencies that do not have an issuer. So that's a difficulty I definitely see, but I would say the distinction is going actually along the MiFID line. And you can see that from not only the MiCA regulation itself, but also the package in total, including the pilot regime. Yeah.
I think what's also interesting to chip in there is the fact that, we have a regulation here. I don't know if everybody is aware of the difference between a directive and a regulation. Maybe just explain it very briefly. So a regulation at European level is something that directly enters into force as the text says it. Well, the directive leaves room for interpretation to the national competent authorities to interpret it according to the existing rule book they have. So there might be the same sentence in the text in a directive that the German government interprets differently than the French one, and then you have a company coming in the space and saying like, hey, we did it with the Germans, and the French will tell you, we're really sorry, but we see it differently. You have to change things and do things differently. And that's an issue, for example, with the security tokens definition, that at European level, you don't have a European definition of what a security is. So it will be very difficult to come up with a definition on what a security token is because of exactly that reason. And the sad thing about this is the Commission is aware of that. And unfortunately, they cannot do anything about it because the member states are all defending their own definitions of securities, which makes it very difficult to come up with a European definition and therefore a European definition for security tokens. So that's already an issue right before we even got into the debate on this.
Well, and Robert, I think you're raising a very important point, and I don't mean to just harp on the definitional stuff here, but I do think the definitional stuff is so important because if you're within the MiCA, then that's a regulatory regime. If you're outside of MiCA, you may fall into MiFID or some other regulatory regime, but maybe you're not regulated at all. And what I keep having trouble with when I read MiCA is trying to figure out where those lines are drawn. when I look at the definition of crypto asset, then it pretty clearly would cover a security token, but security tokens are specifically accepted out right from the definition later. But then when I read the definition of asset reference token, a lot of what I would think naturally fall within that definition look a lot like various types of securities with which I'm familiar. So a lot of them, for example, look like an ETF. And so that's where I'm starting to have trouble understanding where the lines are being drawn so that we can sort of figure out what which issuers are actually covered here. And I sort of, I've sort of developed a shorthand test for myself when I look at any of these regulations, regardless of where they're coming from, regardless of which country. First I look at Bitcoin and I see if Bitcoin's covered. Then I look at CryptoKitties and I see if CryptoKitties is covered. Then I look at frequent flyer miles on a blockchain and I see if those are covered. And then I look at shoes. And if a digital representation of shoes is on a blockchain, which is entirely feasible, right? It's just a database in a lot of ways. Are those covered? And, if all of those things are covered, then I think we're sort of getting to absurd results a lot of the time.
So Lee, maybe let me just jump in. So coming back to Philipp's question, I believe MiCA is something very good on a European level, because what we already saw in the ESMA and EBA advice papers of January 2019, in the European Union, we had an uneven level playing field. So we had different regulatory frameworks when it comes to crypto, starting with what is crypto, what is a token, what is a regulated token, going to how to regulate it. So we had like something very liberal, going from small EU member states to coming to Germany, having very strict regulation, for instance, on cryptocurrency. So in that respect, I believe the MiCA is very good, and because it brings, in that respect, legal certainty. And coming back to your test, I actually like your test. It reminds me a little bit of the Howey test. But what I think we should understand in Germany is that, or in Europe, it's similar in Germany and Europe, that we do not do case law. We more do trying to qualify the facts under the law by looking at if it really falls under the definition. And in that respect, actually, coming back to your question, Lee, the only thing we have is saying that financial instruments under MiFID are not covered by MiCA, but everything else would be covered. And then, but in that respect, I like your test actually, because if you would look at digital collectibles, you made an example on shoes. If I would put a shoe on a blockchain, I would tokenize it and sell it. Why should this be regulated? Whilst if you sell a shoe or ownership at a digital collectible would not be regulated if it would not be on a technological infrastructure such as DLT blockchain. So this is actually something I'm right now discussing also with the German regulator, because this wouldn't make sense. And how I read the MiCA right now, it does not have, like we have it in Germany, an exemption saying, okay, a utility token is covered as a regulated instrument as long as it has an investment purpose. So that's what we have in Germany. What we do not have it in the MiCA. There is no such an exemption. So we have a catch-it-all clause, which is even wider than the German catch-it-all clause.
I think you're hitting exactly the points that I would make on this, Alireza. I think you and I are in complete agreement about the way the test should look, because it makes no sense that digital collectibles, or frankly, real-world collectibles that are put on blockchain, should be covered by the MiCA. That just doesn't make any sense. And yet, when you look at the definition of crypto asset, it is broad enough to cover all of those things. And frankly, I think one of the difficulties that regulators are dealing with here is blockchain technology allows for tradability and liquidity that centralized technologies don't allow for. And so regulators are trying to take concepts from the securities and financial instrument regulations and because of the liquidity of those types of instruments and graft them into the crypto space. But when you look at something like frequent flyer points or whatever kind of reward points, right? If the answer is that because it's on blockchain, it's a crypto asset and subject to MiCA, if that's the answer, that's not technology neutral, which is often what regulators say they're trying to be. And more importantly, it discourages all of the companies from putting their reward points on blockchain, which probably would be better from a technology standpoint and from a legal certainty standpoint and a variety of other standpoints, right? So we end up with these sort of strange incentives that, again, I don't mean to criticize, because I agree with you that a lot of good things are in MiCA, and coming up with a good regulatory regime will be excellent for Europe. And Robert has a lot of important thoughts on this. But I just keep struggling with how do we figure out what the contours of that regulation should look like so that we're not over-inclusive on things that most people would agree just don't make sense to be subject to this type of regulation.
Guys, one question.
Complex, because it's really complex to keep all these definitions apart. I will quickly show the slide again. And let's make the test again. So you have Bitcoin, this is on the left-hand side included in MiCA. You have security tokens, basically shares and stuff. That's the 99% volume of the capital market on the right-hand side, which is excluded, right? So MiCA is covering maybe 1% of financial markets in total. That's a huge gray area on the left-hand side, but we should never forget that it's extremely small right now in comparison to the digital securities on the right-hand side. So let's make your test for other tokens. Where are your miles, the miles and more from the Lufthansa or your other credits from the either node companies? They should be either utility tokens, right? Or most probably they are utility tokens because they give you access for a discount, correct?
Yeah, I think that's right, and they're essentially usable with the issuer of those tokens, which I think is the key piece of the definition of utility token.
Excellent. Could the miles and more from Lufthansa also be an asset reference token? Most probably not, except for the very, very rare occasion that they become basically a payments mean on a very broad range, right? What about CryptoKitties? Where would you put them?
So I actually don't think CryptoKitties fall under e-money, asset reference token, or utility token.
Yes.
But given the definition of crypto asset, it's probably broadly within crypto asset, right?
Yeah.
The definition of crypto asset is essentially a digital representation of value or rights that's on a blockchain or DLT.
Exactly. With one point we should discuss in a second, the MiCA regulation in nearly every second sentence writes that there is an issuer of such tokens, which might be the case. Let's discuss this in a second. And concerning your test, the shoes, where are the shoes going?
So the shoes might be a utility token depending on the way they are structured, but they will almost certainly be a crypto asset. And frankly, if you have a basket of shoes, maybe you have an asset reference token, because the definition of asset reference token includes basically a basket of any type of assets, including commodities. And again, depending on the definition of commodity under European law or under member state law, shoes might fall within that definition. In the US, our definition of commodity is quite broad, and so it would pick up shoes for
but you know, let's one second on this. You know, in case we have real estate tokens could be used as an asset reference token in case you would use real estate to back basically a stable coin, right? But you could also have the ownership token on for a real estate object, or you could have an access token in case you would like to go into this building, right? So this is a hybrid form, and I think it's okay to not say real estate is going in this category or another category, but the question is what to do exactly with real estate tokens. Is it a backing for art tokens, or what is it? Yeah, just as an point here. Okay, Simon, I think you want to add something here.
Sorry, guys, I have to crash the party a bit. When I hear the shoe example all the time, it's a good example to show that something is like, you could say, cheap, and therefore it's not so much relevant. And if you only buy a shoe, why should you regulate it, and so on and so on. What I'm reminded of is a classical example from investment banking, which is the pork belly. Yeah, and there are securities for pork bellies, and then you can do derivatives on top, and you can hedge it. And then you have hedged baskets of pork bellies in different ratings and qualities. What I'm trying to say is the underlying commodity is completely meaningless and is not interesting for a trader. He doesn't care if it's a shoe, a pork belly, or whatsoever. The fact is that the trading itself makes it possible that it is part of the capital markets. And whatever kind of underlying asset is being traded, then we are in the capital market space. And I see a lot of people talking about shoes, real estate, art, whatsoever. Just I have never seen a legal concept that really covers it well enough in a way that it's not a security. If you have really a right an equity right, so to say, for the specific asset you're talking about. So for that reason, I would say sounds good. But if you talk about that from a practical perspective, if you really try to think it to an end, then you will very often go to the security space, and then we're out of MiCA, by the way. And we know how hard it is to define, for example, a utility that's really a utility token and not a security token. There are even consultancies that specialize on consulting ICOs and stuff like that to provide a utility token. But very often, this does not work. And if you especially look at the art market or the real estate market, all the real estate tokenizers ultimately do an SPV or something like that, and then it's a security. So theoretically, yes, all could be possible. Practically, I haven't seen it.
Simon, I like your approach, and you actually got it to the point. We have to look at it. Are we talking about this example with pork belly? Pork belly, you said it yourself. You do not have ownership in a pork belly, but you have an interest to get the dividends from selling that pork belly at a higher price. So you have a vehicle around that pork belly. So you have a basket with different real assets like pork belly, and you participate at the dividends. But what Lee and myself were talking about is really the case of digital collectibles, where you acquire ownership, partly ownership in, for example, a shoe. And okay, you said a shoe is maybe not that much worth. The Nike Air shoe was 60,000 euro, which was traded as one of the highest digital collectible. It was worth 1 year later 60% more. So this is something where you can say, okay, only one shoe, okay, it's not that much worth, but we talk about collectibles. And I think there's a big market. And you said you didn't see anything in that respect. I can just tell you, I'm right now working in such a project, and I'm discussing it.
Happy to see it.
Discussing it with the German regulator. I do not have the result right now, but Lee and myself, we are on the same page. You cannot regulate an asset only because the technology is for you something difficult or something uncertain. You only can regulate a financial instrument. So the financial aspect has to be there. And with the pork belly example, you have it because there's a vehicle and you use it only for trading. But if you have digital collectibles or you have this Hello Kitty token, whatever token, there's the financial instrument is missing at that point.
I think you should take into, sorry, just to chime in there. I think it's very important to see what it's used for, you know, because that just think of what we just discussed. It wouldn't be in the digital world. I mean, would you want people to regulate when you're sharing your collected, I don't know, like Panini cards, you know, like the football things? Should this be regulated? I mean, and what we're basically discussing here is like, just because it's digitized or on a blockchain, it should be regulated. I mean, just put this into a real world example and then think about it, if you would want this to happen or if it's sensible to happen. And the second thing is, before we move back to the topic, I just wanted to say, just from an industry perspective, I think the irony about the MiCA proposal is that when you listen into the industry, I think everybody is happy that it's there. But there's so many details in this that make it difficult to love it. You know, it's like it feels like in German we would say eierlegende Wollmilchsau. So it tries to be everything, and therefore loses out on a lot of more important things that it is not. And I think that's one of the things we will have to look at into the future. And this is point that we're just discussing is actually one of those points. Is like, do we really need to regulate it just because it's on a blockchain? I think that's really one of the key essence of this, because when you look at e-money tokens, for example, I mean, there's a clear rule for e-money that is run in a directive. E-money tokens out of MiCA would be run on a regulation, so they would run in parallel or on top of it. I mean, that's more a legal question, I think. But they basically took the concept of e-money, and because it's on blockchain, it's a new thing and it has tougher rules. And the question is now, why? And I think that's the thing that you have to keep in mind when you look at regulation for crypto assets or everything that's put on a blockchain. So just because it's on a blockchain, it doesn't get more risky or anything. It just is a different way of treating it. I mean,
but Robert,
that's it.
You asked a very valid question. What do you use it for? And I'm
Exactly.
very interested to see what you use the token of the shoe for. Because do you use the token of the shoe for to wear it like one day and then stop wearing it? I'm not sure. I think you use the token to trade it. And so agree, if it's only about technology, I agree that it shouldn't be regulated only because being on the technology. But the purpose of the tokens of the shoe token, for example, is not that we wear it. It's not the utility of wearing it. It's the possibility to trade it and to make money with it, to buy it and then sell it maybe at a higher price.
Okay, then I ask you in return, what's the difference with other shoes that you buy in reality? Because there's a lot of people that buy them and sell.
Yes, I can tell you. It's the possibility that you trade it on a scalable way. It's not that you have to drive around and pick up the shoes and then resell it. It's that you can even build bots that automatically buy and sell shoes. So we are in the space of
But you answered your own question now. It's like, how is it traded?
I like to do this.
This is like a financial instrument. If I would have this token because it's for me like a share that I store, you know, because it has value, you know, I'm holding it basically, then I'm not trading it with anybody until the moment that I sell it, which potentially, if it's, I mean, the shoe in this case is a bad example, but let's assume it's a painting. You have a painting from an artist that is up and coming, you wait till it's becoming more valuable, and that's what you're speculating on. Is there a specific financial regulation that does that, except that it applies, that the tax regime applies when you sell it, you know, that you have an income out of that? I'm not aware of anything like that.
I would like
to... And an important point here, just to follow on what Robert said, an important point here is that if people start migrating databases onto blockchains, then you're going to have both permissionless public blockchains and permissioned private blockchains, both of which will be issuing tokens. And so you can foresee a world where anything is easily tradable because it's on a blockchain using distributed ledger technology and leveraging the internet and people's ability to access the internet. So I take Siemens' point. It's a very important point. And this goes back to the idea that because there's so much liquidity and tradability created by having something on a blockchain, should we be saying, well, let's adopt financial services type regulation for all of that simply because we've increased the liquidity and tradability? And I don't know the answer to that question. That's really a policy question.
I believe if you look at the purpose of regulation, you usually regulate an institution, and here we regulate the purpose of the good, which is not, you cannot do that, because if you look just at the life cycle of an ICO, for example, you start to do an ICO and the token at the beginning is only a utility token. At some point, maybe in year 2 or year 3, you're going to list it on an exchange and then you can trade it. Only at that time, after 2 or 3 years, this becomes tradable. So at which time are you going to regulate it? At the beginning of the issuing in the ICO, on whom are you going to regulate? The issuer, who doesn't even know if it's going to be listed at some point, or are you going to regulate it later on when it is listed? So this is the first point. And the second point, coming back to your point, Simon, If you look, for example, at the black market of football, soccer tickets of the World Cup, they were traded on eBay. This is a high liquidity market. So was eBay regulated? No, they were not regulated. Is Facebook Marketplace regulated because they trade with goods? No, they are not regulated. So I think looking at the liquidity and then to say you regulate the purpose of an item and then make it a financial instrument, that's wrong.
Let me add one more point here. I think we have some kind of confusion here, because I think most securities can be traded, and also the ICO people have been attracted by tradability, because this way they could create tokens and sell them and monetize them somehow. That's why people have been so creative of somehow trading utility tokens. But I really want to make the point that there are like hundreds of possibilities, thousands of possibilities where you would like to have a token which is not necessarily tradable, or where trading doesn't occur, or where trading doesn't make sense. For example, in case I buy real estate, I live there, I own the real estate token, which is basically embodying the right that I'm the owner of the real estate house. This doesn't mean that I'm trading it often, or maybe I'm trading it every 10 years, right? And this does not necessarily make it a financial instrument. But of course, in the past, we have been misguided a little bit, because people wanted to trade anything. Just look at CoinMarketCap, 6,000 tokens, everything being traded. But the world of non-traded tokens, in my mind, has not even yet begun, right? This is something for the future.
And going back to a point that Alireza made, which is, about regulating the intermediaries here. I actually think, MiCA does a pretty good job at sort of trying to figure out how to regulate intermediaries. It doesn't address the point that we've been talking about, which is which assets that the intermediaries are trading should actually be part of the regulated obligations. But if we all just take for a moment the example of Bitcoin, I think it's largely not controversial at this point that if there's some kind of intermediary involved in trading Bitcoin, that is a financial instrument and the intermediary should be regulated. Whereas if it's done on a peer-to-peer basis, then there's no regulation associated with that trade. And so looking at MiCA, especially coming from a financial services background, lots of people will not say, oh, MiCA is going crazy with the regulation of, the trading platforms or the exchange platforms or the execution platforms or the placing agents or, et cetera. So that, from my perspective, I read that stuff, and as a financial services lawyer, I'm like, yeah, okay, that makes sense. But again, to me, the core question is what all is included in that world. And so when do you need to register as a crypto asset service provider and be subject to all of those requirements?
Maybe, Robert, you can add a little bit of context there, because you have observed a little bit the genesis, like the emergence of the regulation, by talking to people at the European Commission and the entire network at your company and so on. So maybe you could provide a little bit more context about what is the goal of the regulation, why did they do it, and why did they do it in this broad way, whereas the markets for crypto asset at this point of time is quite small when you compare it to these 170 pages of regulation which is now existing, right?
Yeah, thanks. Happy to do that. So, we're following the topic as an association now, and we were pushing for clarity of regulation across Europe since 2 years, basically, since the existence. So that was the main goal, actually. It's like clear rules, legal certainty, enabling harmonization across Europe. And, there's two elements to the whole, or actually 3 elements to the debate to how we got where we are. The first one is, as you said, the market is small, so there was hesitance in the at least European environment to regulate this. So what has happened that this changed? Libra popped up, or an entity that was initiated by Facebook, highly popular among regulators, as you know, especially in Germany and France, that put this particular issue on the agenda of basically every reasonable regulator or policymaker around Europe that deals with financial services. So that's basically where this thing moved out of the, I don't know, the garage of interests into the ballroom of European politics. So that's the first thing. Second thing is you have diverging interests on what actually is supposed to be done. Well, the blockchain industry or companies that originate out of the use of technology and that build that protocols and so on are basically happy with being acknowledged as something worth politically discussed and regulated. And on the other side, the fear of this new entity called Libra of changing the ecosystem as it is, risking financial stability, and so on. And in the middle, there was the entity called European Commission that heard both of those sides. And they tried at the beginning, and I know that because I followed this process since 2 years, to take a very light touch approach, a very innovation-friendly approach to this issue in line with existing regulations. That's why you have, for example, the pilot regime on DLT, financial market infrastructure. So that's one of the examples what happened. On the other side, you had political forces, particularly in France, Germany, Italy, that were terrified of this new stablecoin emerging and that basically wanted to create a regulatory regime that somehow slows it down, regulates it, forces it into a place where they can control and navigate it, basically. And what we're seeing now with MiCA is the end result of those two forces at hand. So the one innovation force that basically allowed for, getting regulation, regulatory certainty, and innovation-friendly approaches, together with the overarching fear of having something in the future that cannot be controlled and want to be basically slowed down. And that's why you have like a lot of mix of principle-based approaches in the regulation, and then technology neutral infringements like the e-money token, or some of the definitions for significant asset reference tokens. I mean, there's a point in there that says interconnectedness to the financial system. And this is a clear, joker tool. Basically, whenever you're not falling into under enough criteria, we'll just pull this out and say, like, you are, now we can do whatever we want. And this is, a bit of a dangerous path we're on. I mean, this is not the end result, as Philipp said at the beginning, but there's some of these elements that if we go in the wrong direction here, and there's political pressure because of that and occurring because of that, then this, could stifle a lot of innovation. I think there's a lot of entities that will look somewhere else or will be, just not being able to operate because of compliance costs, legal uncertainty that occurs. And, I think it's just important to keep in mind that we're not just talking about technicalities here, but there's political forces at play that will influence this very much, and already did actually, and not just, at European level, but across Europe, you can see this a lot. And I mean, Germany is a good example for that as well.
So the MiCA regulation has now been proposed, and I think basically on the same time, a couple of finance ministers said in an entirely different context that Libra probably should or could be forbidden, right? So this is something else than is written in the MiCA regulation, like comparing the MiCA regulation to the speeches of these couple of finance ministers from Europe. You would even call the MiCA regulation liberal in comparison what these ministries have said, right? Is this what you mean, that basically the details need to be interpreted and we need to be careful that not too many political influences basically is impacting the execution of the regulation?
I think the biggest issue we're still facing at European level is the lack of understanding of the material we're actually discussing. I mean, I don't know, that's just maybe the experience that we have at EU level, but I can imagine, and talking with people in the member states, we see that a lot of policymakers that you're talking to when you're explaining the issues, that they still don't grasp the opportunities that are there, the technological bits about this, all the bits and pieces that you simply need to understand. I mean, we're talking about a complex issue, we're not talking about, sorry to take this example, shoes, but but there's still a lack of understanding that is actually necessary to approach this properly, I think. And this is the biggest risk, because I think if there's proper understanding, then the end result would look different. And that's still a big issue at the European level.
So, Alireza, I think you are already having a couple of startups as clients of your law firm, right? So, what's your opinion? Can startups basically comply with these partly drastic regulatory hurdles, or do you really have to be a huge financial organizations to be able to tackle the hurdles? What's your opinion there?
I mean, yeah, you're right. I'm working together with startups a lot, but I'm also working together with major crypto exchanges, one of which I also advised in getting the crypto custody license in Germany. So I was looking into that topic also for my clients to see, is it possible for them to get the license? Is it now possible? Is it later possible? Is it better to have a joint venture? So what Robert actually said is very important. This is a MiCA. The MiCA is directly applicable to all EU member states, but it will take time until it is applicable. So it will take time, I would say at least 2 years. For these 2 years, I think the startups which I'm advising now, they could prepare themselves to comply with MiCA once it is applicable. But if it would be applicable right now, I think they could not do it. They could not do it for many reasons. Major reasons are the own capital part, which I would need as a regulated financial institution in Europe. The second part is the team that would need to have a team of experienced bankers, and then the ongoing compliance they would need to do and to implement in their business, which would be not something they are familiar with, because they are startups. They may be fintechs, and maybe no fintechs, but they will be very, very much it would be very difficult for them to comply with it. So therefore, I would say point now they could not deal with MiCA. In 2 till 3 years, maybe. But until then, they could joint venture with regulated entities like a bank or regulated crypto exchange. This could be a solution.
Okay, and Alireza, one more question. You are also knowledgeable about the Liechtenstein Token Act, which is a fascinating regulatory scheme, right? What is the core difference between MiCA or the MiCA and the Liechtenstein Token Act? Is it basically the silo building in the MiCA regulation versus the very, very, very generic approach in Liechtenstein? What is the key difference?
Yeah, I mean, the Liechtenstein Blockchain Act, it is similar to the German draft bill for electronic securities. It first of all brings, from a civil law perspective, certainty. So it gives guidelines on how to deal with a digital asset, which is not a physical asset. So it doesn't really regulate it as MiCA is doing. MiCA is a regulatory framework which really regulates the product and the intermediaries, whilst the Liechtenstein Blockchain Act gives certainty on how to trade with digital assets by putting the silo principle around it, and by giving to the intermediaries the possibility to register themselves, or not to get a license, but to register themselves, and then to comply with what I would say a light regulatory regime, rather than putting them straight into like the very strong, very tough regulatory regime like MiCA or the German banking law requires the actors to do so.
Okay, excellent. Anybody wants to add something here? Simon, you want to add something?
Yeah, just maybe one aspect. I think I understand that it's difficult for a startup to go into this business, and there's a fear that you can't do anything in the blockchain space now without having high knowledge about regulation, and even then high costs as well for the legal consultancy. The point is a bit, I think that I understand this fear, and then, however, regulation is made for the bad times and not for the good times. And I understand that most of the people may have like good intentions and reasons for doing what they do, but the reason for the regulation is that it can be misused. And if it creates a regulatory hole, so to say, into the existing financial systems, then we have seen that this hole will be used. And then maybe some people will jump on it and simply like issue some tokens instead of other instruments, which serve the same purpose. And that's the reason why I very much like this approach to think about the purpose of the vehicle and what it is used for, because this is how it will be used in the market. The market doesn't look for things that are intended, but how things can be used. So it's a term of practicality and how to also maybe misuse assets. And for that reason, I pretty much still think that's a good idea to try to cover as much as possible. So these buckets, yeah. And I also think that it's important to take the issuers and the intermediaries as well into liabilities, because it makes them responsible, and it thereby takes or implies that people will try to handle these tokens responsibly as well. So I understand it makes it more difficult. Completely agreed. And there might be some damage due to that in terms of innovation. But Robert has, I think, nicely pointed out these two poles which are pulling to the regulation. And we have seen that it's quite relevant that we don't create holes in the financial regulation, because they will be used and the effects can be more harsh than the avoidance of innovative powers.
I think Simon makes good points. I think Alireza makes good points. I would just also add, from a very practical standpoint, the crypto asset service provider has to maintain insurance in certain circumstances. Obviously, they'll have to open bank accounts, and there will be need for auditors as well. I think we've seen in the crypto and blockchain space for quite a number of years now that there's been difficulties for firms that are native to that space in getting insurance policies, in getting auditors, in getting bank accounts. And so while I completely take Simon's point, and I do believe that having some kind of regulation for certain activities is important, we also need to make sure that we make available those other services that these startup companies will require. Otherwise, they just get blocked out of the market through forces that should be, pretty easy to overcome.
Okay, so I have one question here coming from the internet where people are watching us. It's an interesting question. How will these regulations also impact non-European players who are serving European clients? This could be a US bank, right? This could be Asian crypto exchanges. Who would like to quickly provide an answer here?
I could do it. It actually depends if these players are targeting the European market, actively targeting. So this is the test you have to do. If they do it by reverse solicitation, which means the client coming from the European Union or from the European member states would request the services by their own intention without getting approached by the US player, this is reverse solicitation. So this would be allowed. But other way around, if, for example, a Coinbase or someone else would come and provide marketing to the EU by changing the web page to German or to any other EU language, this would already be qualified as marketing the EU nationals.
Oh, Ali, you are muted.
Sorry. I was just going to say, given the quality of the English that all of you German speakers are speaking, I think it's probably doesn't make that much difference if the website is in English or German at this point. So, and it actually raises a really interesting point, the reverse solicitation question, because as more and more people are starting to speak English and a few other languages, it starts to get harder and harder to say what's a reverse solicitation and what's not. But I overall agree with Alireza's points. I think it's very important. And to me, the most interesting aspect here of the MiCA was the requirement to have a local European legal entity if you are going to service European personnel. And I think that's something that's similar under the requirements in GDPR, right, to have a local legal entity. And that really serves to give jurisdiction to the European at the European level and at the member state level.
Okay, I would like to add another perspective on this question, because you could also see that now a regulatory fundament is now arising or soon existing for more than 400 million people, right? So this could also provide an incentive for large-scale corporations to enter the market. For example, MasterCard, Apple, Google, they maybe create their own version of Libra, but compliant with the e-money token regime, for example, you know. Do you see these developments coming, you know, like regulation, providing a solid fundament, creating an incentive for large-scale companies in Europe or outside Europe to invest in this market? Because regulation now is there for a couple of 100 million citizens.
I think they're far ahead than waiting for regulation. I mean, for some of the payments companies that you just mentioned, I know that they're already working on this. This is not a matter of if, it's a matter of when. The same for a lot of other big tech companies. You know, they're basically all sitting in the labs, creating the code, cooperating with the industry and protocol companies in the space already. So this is not really a question of if this is coming. The question only is when it's coming and how the world will react to that. I mean, that will be actually also the most interesting thing, I think, about Libra, you know, because when you read those BIS and FSP papers, they're estimating the size of Libra somewhere between, I think, 150 billion and 3 trillion or something. The question then is, what if the consumer doesn't like it and they just say like, and it doesn't work, nobody cares, we still stick to our cash or whatever it might be. You know, so it's on some of those levels, we're a bit behind what's actually happening and what's needed. And on other issues, we're so far ahead, like spinning our heads around on hypotheticals. It's quite interesting that not a lot of discussions actually really happening on what's going on the ground. And that's, I think, something that we should change and has to change when we talk about regulation. I mean, it always feels we talk about what happened. ICOs, for example, it's terrible and everything should never happen again. Or Libra will become so big that it probably will make the financial sector collapse. So I don't know, there's a bit of a disconnect sometimes between looking at what's happening on the ground and what we should actually address, but being open-minded about it. You know, like to leave doors in this regulatory processes to innovate, review, and so on. And not
what
just...
you're mentioning, Robert, then feels that the MiCA regulation is also a little bit reactive to Libra and also the ICOs, right? And you mentioned that others, you know, like MasterCard, Apple, Google, and so on, they might be there, have their concepts ready and wait for regulation. This could, for example, concern the e-money tokens, but, you know, on another aspect here, also one question coming from the group here. On another question, this regulation now also could open the door for institutional investors entering the crypto asset area, for example, Bitcoin, Ethereum, and so on, because now you have a reason to investigate this topic, a reason to invest, and so on, because the market is now basically opened up. Maybe Simon, do you see that this is coming? You know, is the Deutsche Börse now creating like a Bitcoin lab, something like this, or to explore whether institutional clients in your client base would be interested in doing so?
I think what can be stated in general, what is quite interesting is that the financial institutions do not need specific additional licenses for providing roles within the MiCA regulation. I think this is a quite interesting aspect that we also had already talks with our clients. So let's see if they take the opportunity, but currently they have it. And I think this is something quite interesting because it gives them an opportunity. And I'm not sure yet if we'll see that, but I think in general, the market was in a stuck mode somehow. We as an infrastructure provider were not having something because there was nothing that we could provide from the non-crypto tokens, because there was only a very limited market, so to say, and because there was no institutional demand for these tokens, and there was no clear regulation for that. And regulators maybe said, like, look, there are not so many assets to regulate, and by the way, we don't see infrastructure that we could regulate. And the market then said on the other way, okay, I don't have infrastructure to trade on, and I don't know what to trade because of regulatory unclarity. So now the regulator has actually moved at first, which I really appreciate and which I wouldn't have expected maybe in that way. But on the other hand, this now pushes the move, of course, to us and to our clients. And we see that push, and we want to react, definitely. And this is something we are looking into. And the question will be, what kind of asset classes do you target? For us, the most relevant are still the ones that are rather out of MiCA than in MiCA. But still, this is something, of course, which can be done on the same technical basis. So from a technical perspective, you have technical components that can target both sides. Yeah. And then, of course, the business case for going on the other side, on the crypto side or the crypto asset side, is easier if you already have the technical components from the financial instrument side. Yeah. So okay. I think there is a higher incentive now.
Okay. Last question for today. We are soon finished. Give us a couple of more minutes. We saw with the GDPR, which is also extremely complex, and very often people didn't like it so much. Europe was still able to basically export the rules enshrined here to a couple of other countries. You know, do you see this now also happening with the MiCA regulation, for example, that the e-money tokens, the asset reference tokens, the definitions here and there, the service providers restrictions here and there are basically also taken potentially elsewhere, or would you not expect this to happen? Yeah, for example, in US, such a systematic regulation approach is missing. In the US, as far as I know, very often institutions are still fighting against each other, who is basically competent to do something, right? So what's your opinion here?
I mean, on the US, sorry, then.
No, go ahead, Robert.
No, just very quickly on the US. They just introduced 2 bills into the Congress, one on crypto assets and one on payment systems. I mean, actually, Leo, much better place to talk about this, but I think there's movement now on a lot of fronts, and I think a lot of entities or places are looking towards Europe, but also then the US, what will be done there. But I think in the US, it will take a bit longer, from what I understand of the political process.
I think that's definitely right. And sadly, you know, I don't think in the US there's much appetite to say, well, Europe's doing it, so we should do it too. We tend not to want to follow what other people do. We tend to want to do our own thing here in the US. I do think, though, that having this kind of a comprehensive draft out there is going to set a model for a lot of countries. And I have no doubt that US regulators will be studying this quite closely to see if they agree with the concepts and want to try to do something along these lines, or at least take some of the concepts and work them into regulation for the US.
Okay, excellent. I think with this, we are now at the end. I think it was a very interesting discussion about multiple aspects on other countries, companies here, companies elsewhere, startups, large-scale financial organizations, and so on. I would like to thank you all for your time. I think we do such another round in a couple of weeks or months again to see where we are heading. In total, I think the key summary would be that the MiCA regulation could be judged a positive thing, so it will not close down innovation in this area. It will not close down Bitcoin and other crypto assets, but potentially rather create a fundament for growth based on various means. Okay, thank you very much, and talk to you soon, very soon.
Thank you.
Bye, guys.